Did you know that 9 out of 10 high-growth European startups struggle to secure the capital they need to scale? This is exactly where venture debt becomes a game changer.
It's an instrument which could be relevant for a lot of companies here. So basically, venture debt is a loan provided to an innovative, high-growth, high-potential, typically VC-backed company.
Today, I'm joined by Gergely, Senior Investment Officer at the European Investment Bank, the leading provider of venture debt in Europe. The European Investment Bank is not just a bank, it's the European Union's financial arm, fueling innovation and growth.
This helps to unlock funding at the stage where this is needed. It's also a risk mitigation tool for the...
In this episode, which was recorded as a Fireside Chat at the Bio Europe in Barcelona, we will uncover how venture debt can catapult your company's growth without diluting your equity, the unique advantages of European Investment Bank's venture debt solutions tailored for European innovators, real-world success stories of companies supercharged by EIB's support.
I think the most famous story, this is maybe a little bit of a special situation, but the most famous is BioNTech.
Don't miss out on this invaluable knowledge. Subscribe now, share this with fellow CEOs and investors, and leave your comments on social media. Let's unlock the power of venture debt together. Watch the full episode now to gain a competitive edge in the financing landscape.
Venture capital fuels innovation, but very often it's not enough for the companies and they need more capital to accelerate their growth. And this is where instruments like venture debt come into play. But honestly speaking, when I first heard about the term venture debt, I thought, venture what? That's why I'm happy to have Gergely here with me today on stage to talk about this instrument, Gergely from the European Investment Bank. And can we start with answering the question what venture debt is?
Thanks, Christian. So great pleasure to be here, and really happy to talk about this. I think it's an instrument which could be relevant for a lot of companies here. So basically, venture debt is a loan provided to an innovative, high-growth, high-potential, typically VC-backed company, which is not yet, I would say, ripe enough for traditional bank debt because the company is usually either still burning cash, so doesn't have a history of positive cash flows, or doesn't have an asset base which would allow for asset-based financing. And so this is an interesting tool that helps to these companies to achieve further growth.
But what's the difference to bank loans? Why do I need to go to the European Investment Bank and not just to the bank around the corner to get a loan?
Sure, yeah. I think there are, I would say, two key differences. So although this is technically also a loan, it has certain features which are maybe a bit closer to equity from a certain perspective. So on the one hand, the investment is typically tranched, and these tranches are made available based on certain operational, financial, or commercial milestones being achieved. This helps to unlock funding at the stage where this is needed. It's also a risk mitigation tool for the bank, obviously. The other feature, I think, is obviously in the structure of the pricing, because this is companies at this stage are typically not eligible for bank loans, and so the risk that the lender is taking is also higher than what a traditional bank would be taking. So this is reflected in an interest rate, and then there is also an equity kicker. It's either in the form of warrants, an option to be able to obtain shares in the company, or royalties. This helps to balance the remuneration structure and allows the lender to build a sustainable portfolio.
When I think about the situation of the founders, they start a company and then have big dreams. Some are early on the market, find customers, then approach venture capitalists, and then they discover venture debt. What's the main advantage for the founder situation of venture debt?
Yeah, well, I think one of the most obvious is obviously it limits dilution, right? So you don't, as a venture debt lender, you don't acquire a stake in the company. So it limits the dilution to the founders. It also it allows the company also to go faster and achieve maybe the next milestones quicker. So in that sense, it's the next funding round, when it's raised, it can be raised at a higher valuation. Usually it allows the company, gives them more liquidity, more runway, allows the founders to focus more on really running the business instead of just raising funds. And I would also say that as a venture debt lender, we typically don't take a board seat in the company, so you don't really disturb this balance of power that you have on your board. So there's no need to open up the board again for a new board member.
Yeah, that's a good point. Usually when you come into a company, the company already has venture capitalists on board, and they already have a funding structure and a cap table. And then there is the new party, European Investment Bank. How does the collaboration between the venture capitalists and your team look like?
Yeah, well, typically, actually, we source about half of our deals from VC funds. So very often is the funds contacting us. Let's say we do a transaction with one of their portfolio companies. And then they say, okay, well, actually, this could be very interesting for another portfolio company. Obviously, for the VC funds, it helps also to enhance the IRR on their investment. We take a pretty hands-off approach, so we don't interfere in the operational affairs of the company. We try to support companies which we think have a strong management team and have a reliable, good shareholder base. Strong shareholders who have already supported the company in the past, who've demonstrated that they are willing to do so, and who we expect will continue to support the company going forward. Maybe it's also important to point out that we expect also shareholders to continue contributing to the growth of the company in future funding rounds to help co-finance really these investments.
When we talk about funding rounds, I mean, usually you have the pre-seed, seed round, Series A, Series B, Series C, and then some crossover rounds for an IPO. What's the ideal point for you? Are you supporting all companies regardless of where they stay, or do you have an ideal company profile when we think about the funding stages?
Yeah, so typically, I mean, venture that complements venture capital, right? So it doesn't replace it. So usually, a substantial amount of equity will already have been raised by companies receiving venture debt. In terms of financing rounds, I would say ideally would be typically post-Series B, post-Series C, depending on the case. For sure, first institutional rounds, or at least a large Series A, at least, really depends on a case-by-case basis. But I would say ideally would be post-Series B or Series C. We try to look at it in a way that we try to lend to companies who we think will be in a position also to operationally repay the debt at the end of the tenor. Typically, we work with long availability periods and also long tenors, so typically bullet structures. So we try to focus on companies who we think will be in a position then to repay when the time comes.
That's an interesting point. It's not only venture capitalists that are in the company usually. When I think about other funding partners, we also have a lot of public grants in Europe. And the thought just came to my mind while you were speaking. How do you handle that when you see a balance sheet where you have also a lot of public grants in the company? Is it a limiting factor, or can it be a limiting factor in the funding structure that you say, okay, this is too much, we can't give additional public money into the company, or doesn't it matter?
Well, I think it does. I mean, it's something that we take into consideration. So we do have rules on that, right? We are a public institution. We are the the lending arm of the EU, and we really try to, our role is to crowd in further investment that includes also private investment. So we would try to avoid a situation where basically the entire company or very, let's say, large project is financed predominantly from public sources. So in that sense, we do take into account what sort of grants the company has received or is expected to receive. And then that is kind of deducted from, let's say, the scope of what we can finance. So in that sense, it's to a certain extent, I don't know if a limiting factor is the best way to call it, but it's taken into consideration. On the other hand, I think usually companies at this stage that we lend to them, grant funding at that stage would be fairly limited. So it doesn't interfere that much.
That's great. That's great. I can't help but anytime when I hear that, I think immediately about loans. What are the misconceptions that you usually encounter when people talk to you about venture debt?
Yeah, well, I think one of them is, So I think there's one misconception as to whether this is some type of equity funding or how it works and whether there's a need to repay or also the difference to a grant. So as it's a loan, technically there is a repayment obligation at the end of the tenor. It's not a contingent loan. It's a loan with a repayment obligation. So I think that's one misconception. There's another one, I think, which kind of relates to the fact that we're a public institution, that this is not a subsidized instrument. So the goal here is not to provide a subsidized loan. Obviously, this is more beneficial in terms of pricing than raising equity, but we need to make sure that we're pricing the risk that we're taking to ensure that we can build a sustainable portfolio, so that this tool can be made available to innovative companies going forward as well. And I'd say maybe the third misconception is that this doesn't replace equity, but it complements equity. So it's an add-on that allows companies to go faster. It allows to establish a more ideal funding structure, but it's there needs to be that strong foundation of equity there in the first place.
On the market, there are companies that are venture funded, and then you also have the bootstrapping story. So some companies make it without venture funding. And what would be your assessment when a company approaches you with revenues, customers, but no venture capital on the cap table? Is that still a possibility, or is that out of your scope then?
No, that's a possibility. So I think the typical case would be a VC-backed company. But also you have, family offices supporting companies. You have bootstrapping. So that's we don't exclude it. We look at the case. I think what's important really is to have to make sure that there is an appropriate governance structure in place. That's very important for us. So if that is the case, the business model works, the management team is good, and the business case works, then of course we do consider it, and we do finance companies also like that.
Governance structure is, I think, an important point, and this question just popped up in my mind. What are the minimum criteria that you look for in governance in companies?
Well, we want to make sure that there is really a professional management team in place. There is a board. I wouldn't say that's a minimum criteria, but ideally that there is an ideal situation. You would have an independent chairman. And you would have some independent board members. Also very important maybe for companies in biotech to have an advisory board in place. That I think that also helps a lot. So these are what we look at. It's I think overall there's no criteria in terms of governance which would be set in stone. But overall we need to feel comfortable with the governance structure.
And in case you feel uncomfortable with the governance structure, do you make recommendations, and can companies fix that and come back later to you, or is that something that you don't do?
Well, yes and no. I think for a lot of companies, actually, we engage with them much earlier than we actually end up entering into transactions. So there's usually some dialogue preceding the transaction. Sometimes companies are already at the right stage at the first contact, but very often we tell companies, look, you're a bit too early still. Maybe if you have, you get to this point in the development plan where you raise more equity, it would be a good time to talk again. And yes, there I think we can also highlight maybe some governance aspects. We do have an advisory team also at the bank who can maybe help companies on their journey to becoming, let's say, more bankable. So in that sense, yes.
Yesterday, at the panel discussion, there was the question, what's the right time to approach venture capitalists? And during my career, I heard several opinions. Some say you only go on the market when you have something to sell or when you want to raise funds. Then other people say you should always be on the market, build investor relations. How is it with venture debt? What's the right time to approach the European Investment Bank? Should the founders just come to you when they need desperately money and say we have 2 weeks and then it's over? Or is it similar to what venture capitalists suggest nowadays, that they should start earlier building relations before they need something?
Yeah, I think definitely earlier, the earlier the better, right? So we think usually the process takes some time. So also that is maybe something that needs to be factored into the expectations. So it's a lengthy process. We need to do due diligence. We need to do some background checks, KYC, and so forth. So before a transaction is signed and then disbursed, it does take time. So I think in that sense, definitely, this is not a last minute instrument, something to be prepared for. Plus there might be questions along the way. So I think usually a very good time is maybe after a funding round has just been closed. That's actually an ideal time, because at that point, companies will typically already have a very good information package in place. Data room will be set up. It allows us to also go through things in a more timely manner. And then this, you're just adding a little bit of venture debt on top of the equity that has been raised, I think really helps companies to go faster, maybe pursue an additional program. I think that's kind of the ideal case for venture debt.
What can companies expect when you look at the case in terms of material? You mentioned due diligence. What is your expectation? What should companies have prepared? Which data do you want to see during the phase where you evaluate the company, if it's eligible or not for venture debt?
Well, if it's eligible or not, I think in that stage, usually we start with a non-confidential pitch deck. So that's the first contact. We look at that. Usually there's a first call with one of our investment officers, and if that we come to the conclusion that this could be of interest to both parties, then we also involve our technical team. So we have an in-house team of experts with a background in research or in the industry, or who were entrepreneurs before. We work together very closely with them. So they also have a look at the case. We usually organize a joint call, and if they also think that this is something worthwhile pursuing, then based on that we have a first kind of interaction in the team. It's called a go-no-go meeting, and basically the purpose of this is to decide whether we want to allocate the resources to appraise a project, right? Because it's a long process. And if the answer to that is yes, then that is when I would say the bulk of the work starts. So there we would expect a data room, which would be very similar to, I think, what a VC would expect on the product, the technology, the market, obviously the management team. business plan, and also certain additional policy aspects that we have to take into consideration as a public institution.
How long does it take to close a round with you?
Yeah, that's that's a very good question. So it depends a little bit also on how ready the company is. So if we're in the situation where, let's say, a funding round has just been completed, and so the data is available, it can be made available quickly. We usually say it's about 6 months from the date of due diligence, but that's just a high-level figure. It can take longer, and it can be a bit quicker, and then it also depends, of course, on negotiations, right? So how protracted negotiations are. Sometimes it's very quick, and sometimes it can take longer. So there are several factors involved.
Is there a lot of room for negotiations with the contract, or are the contracts pretty much standardized that you work with?
I would say they are standardized to a large extent. Of course, in terms of commercial terms, that is subject to agreement. We need to find a structure that works for the company, works for the bank. We need to make sure that the remuneration is kind of in line with the risk that we're taking. We need to look at the business plan. I mean, the whole structure needs to fit the business plan, right? So that's the only way it would make sense. So we need to find CPs that help to unlock the funding as it's needed, as the company achieves the next development stage. But it's also obviously a de-risking tool from the bank's perspective, right, to make sure that things are on track. And then for the contract, I would say most of that is fairly standardized, so the legal wording. But of course, there are subtle differences, and we work across the EU. So there are different jurisdictions, and then there are some subtle things in every jurisdiction. But I would say most of the contract is fairly standard. But the important thing is really to agree on the structure, to find a structure that works.
Out of curiosity, I mean, contract negotiations can be very lengthy and can take a lot of time. I wonder, how does your team handle that when, let's assume, someone is interested and they start negotiating and then come back and wants to negotiate the next point and the next point. Is there a time cut off in your team where you say, okay, it doesn't move forward, or are you on the patient side and say, whatever it takes and how long it takes, we are there for you?
Well, I mean, it's a question of allocation of resources, right? So, we have a limited number of people working on these transactions, and a limited volume of funding that is available. So, we try to prioritize transactions. We understand in certain situations things can take longer. Maybe the situation changes, and understandably so, and then we would need to open up certain things, and it can take longer. But it's also, if we engage with a customer or a potential customer, that means that we're allocating our time to that transaction and not to another one, which could potentially go ahead. So I think, we need to be reasonable, and I think clients understand that. So usually we manage to come to terms with most clients. Of course, there are situations where it doesn't work, and there could be that maybe after a certain point we say, well, look, if this is not the right instrument, then maybe this is maybe we should just stop there. But I would say that's rarely the case. So, yeah.
So both parties should keep the ball rolling towards the goal and not get stuck in there. The market is global, the market is international, and companies in Europe can also approach entities in the United States, in Southeast Asia, in the Middle East. What's your competitive advantage? What's your secret sauce? Why should companies come to you and choose you as a venture debt provider, not others?
Right. Well, I think we're a patient investor on the one hand, and we're a policy-driven investor. So we support projects which are aligned with EU policy objectives. And also we have, I mentioned the technical team before, so usually companies who we lend to, they're subject to thorough due diligence, and it's considered a stamp of approval if the EIB invests in a company. It will allow the company to raise funds more easily going forward. We provide a substantial amount of funding, so typical ticket sizes between 15 and 30 million. I think that's larger than what most providers can provide, and also the tenor is fairly long and the availability period is fairly long. So we try to design the instrument in a way that allows companies to really focus on development, to continue investing, and then to repay at a time when the business plan allows for this. So I think these are our key advantages. We're hands-off investors, so instead of getting involved in the company and trying to influence the direction which the company should take, we rather try to invest in companies we think have a competent management team and a strong shareholder base, and who we trust that will take the company in the right direction.
In your opinion, when I look at the European landscape, especially at growth companies and in innovative companies, how does your team assess the impact of your venture debt instrument on the European growth scene?
Well, there are studies that we do on that, and there is also things that we look at while assessing the company. We try to understand, for instance, how many jobs will be created, whether these are highly skilled jobs, for instance, in R&D in Europe. There is also a direct effect in the sense that we're allowed to finance up to 50% of a given project, and 50% is the ceiling. So sometimes it's lower. That means that the remainder needs to come from other sources, right? So there you already have a direct effect in terms of crowding in further funding. But actually, our economics team has run a study recently, which found that companies that we've backed have raised, I think, about 2.5 times more capital, or were able to raise 2.5 times more capital following the EIB loan than companies who were similar but hadn't received such backing.
Did I understand it right? You can take up 50% of the capital needs of the company with a venture debt instrument?
This is a policy limitation or a policy aspect. So yes, up to 50% of the project going forward can be financed, right? We would typically be lending to companies who had already raised a substantial amount of equity. So the company had already been equity funded to a large extent to get to that point where we get involved. And maybe it's important to point out that the 50% is a policy aspect. There's also a risk aspect of how much debt can the company take on, what is really the right size of the investment, so that we don't put too much pressure on the company at the time of repayment.
That's amazing. I mean, it doubles the investment, basically. It's a good thing. In the last 3 minutes, can we talk a success story through? Do you have a company that was particularly successful and that you can use to explain how the process works, what the outcome is, and what the end game was?
Yeah, I think the most famous story, this is maybe a little bit of a special situation, but the most famous is BioNTech. So we were actually the first financial investor to back BioNTech's COVID program back at the beginning of 2020. So we actually signed a 100 million loan agreement with them at the beginning of June 2020, which was very early, just really 3 months into the pandemic. And while the company was obviously able to raise a substantial amount of funding later on that year, I think it was this initial commitment from the EIB really helped them to continue their development program full speed ahead during the summer of 2020. So that probably led to maybe a time advantage of 2 to 3 months for the development of the vaccine. This is my assessment. I don't know if that's really the case, but just looking at when the company raised additional funding, I think it's fair to say that the EIB loan really helped them in this. And apart from this being a huge technological and commercial success for the company, and this being their first approved product, I think the benefits are very clear for society. It helped. It was the first COVID vaccine to be approved. It helped put an end to the pandemic earlier, and it allowed everyone to, society and people to return to their normal lives, the economy to return back to normal, and of course saved many lives. So I think that's a very, very plausible case of what this instrument can help to do.
When I remember it right, I think the first idea of the vaccine that I read in the news was in February, and then they needed additional capital, and you stepped in immediately and closed the deal. Was it 2 months or 3 months?
Yeah, it was 3 months. Yes.
How could you work so fast?
Well, to be fair, we'd already signed a loan with BioNTech before. So actually, in December 2019. Which was to support their cancer program, and then all of a sudden the pandemic hit, and they decided to take a go at it and see if they could develop a vaccine to tackle this. They were very self-confident in this, and rightly so. And this allowed us to move faster, but it was also a special situation. So there, everyone was very much focused at the bank on making this happen, so that we as Europe, right, as the lending arm of the EU, we can really show what we can do to help put an end to the pandemic.
Gergely, thank you very much for these wonderful insights into the EIB venture debt instruments. Keep up your great work. I think it's a great addition and a great help for the European ecosystem.
Thanks, Christian, and thanks for the opportunity to be here and to talk about this.
In this eye-opening discussion with Gergely from the EIB, we've explored the transformative potential of venture debt. We have learned how it can fuel growth without sacrificing ownership, and we have seen firsthand how the European Investment Bank is championing European innovation. If this episode sparked new ideas for your own financing strategy, hit that like button and share it with your network. Your engagement helps me reach more influential voices and bring you even more valuable insights in the future. Remember, the right financial partner can make all the difference in your company's journey. Explore the world of venture debt, and who knows, your next big breakthrough could be just around the corner. Thanks for tuning in.